Like I told you last night, growth at any price went out of style in the Wall Street fashion show nearly 6 months ago, as we saw yet again today. Now what this market wants is something entirely different. It wants GARP, growth at a reasonable price. That's why we spent the weekend chopping up the S&P 500, running its constituent parts through a series of screens to identify companies with above-average earnings growth but enticingly cheap valuations. We're going sector by sector. Yesterday, we kicked things off with the GARPiest travel and restaurant stocks because I think the whole space will boom as COVID recedes. People are desperate to leave the house. Tonight, though, we're identifying growth at a reasonable price in another group that should thrive in this environment, the financials, one of the few industries that benefits directly when the Federal Reserve raises interest rates. Now, later this week, earnings season officially kicks off, and we're going to hear from the 6 largest banks in America, beginning with the largest, J.P. Morgan, tomorrow morning. But if you're looking for growth at a reasonable price, you should look elsewhere. You might be better off focusing on the more under-the-radar, underappreciated financials that the major money managers really, they've been fleeing them like rats from a sinking ship, creating the opportunity that you need to run toward them. Tonight, I've got 4 of them that pass the GARP test. So let's start with number 1. Let's start with Signature Bank. This is a New York-based commercial bank, but it's got 36 private client offices sprinkled across the New York metro area, California, and North Carolina. The thing about Signature is that it's a business-oriented bank, and to the extent that they have a consumer business, it's focused on the wealthy, namely business owners and senior executives who do a lot of business, and you can make a lot of money working with. This is not a stock we've covered too often, although I mentioned it in January because it was the 5th best performer in the S&P 500 last year. I went over the top guys. At the time, I told you Signature had run too much. Recommended waiting for a better entry point, just finding a bank stock that was cheaper on a book value basis. Well, that was a good call. Stock down 17% when we did that.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.